Hello and welcome to another episode of The Index Investor. Today we're going beyond the headline numbers to understand what index funds actually hold, how indices are constructed, and the hidden risks investors often overlook. Joining us is Viswanadha Raju. He's co-founder and CEO of Unien Capital Advisors, which is a SEBI-registered investment advisory firm. Vishy, great to have you here with us.
Hi, thanks, Ruchira, for inviting me over, and hello to all the viewers.
Now, let's begin with the basics. So, when we invest in an index like the Nifty 50 or Sensex, what exactly are we buying into?
Yeah, to explain it in easier terms, index is nothing but a basket of stocks that is selected based on a transparent filtering criteria. Right? I might say that an index is the top 50 stocks in the country, right, by market capitalization. The top 50, the largest 50 in the country will be a part of my index, right? That is what is your Nifty 50, which is the top 50 stocks listed in the country on NSE India, National Stock Exchange. Similarly, BSE has got another index called the Sensex, which is widely followed, right, which is the top 30 stocks. Okay. Now, similarly, I can say that I'll have an index of all, for example, auto stocks, or all banking and finance stocks, or the largest 20 stocks, right, in the consumption space. So each one of these can become an index. It's a basket of stocks, and depending on the market capitalization, the size of the particular stock in terms of as measured by market cap, the weightage within the index could be different, right?
Okay. Who is deciding what goes in or out of the index? And
these are separate agencies for this, right? For example, the Nifty 50, right? Again, these are rule based, right? It's not that one can decide on this stocks or composition of an index based on one's whims and fancies. There are agreed upon rules that are published, right? And the index stocks also get reviewed periodically, depending on which index that we take. It could be quarterly, it could be semi-annual, it could be annual as well, right? And depending on how the stocks move, etc., the index is configured, I would say, or adjusted based on how the underlying stocks are moving, right? For example, NSE indices, if we take a look at it, there is a separate company which is called NSE indices, right? Which takes care of all this monitoring, review, tracking of various stocks, and coming up with these indices, which are then widely followed.
Right now, over time, new age businesses and sectors emerge while others fade out. So, how do index builders keep up, and are they doing enough to stay relevant?
Yeah, absolutely. You would see that, if I go back, let's say 10, 20 years, for example, right? If I look at Nifty 50 itself, very easy example to track and follow. In the year 1995, for example, information technology as a part of Nifty 50 was zero, right? By the time we came to 2005, information technology was almost 20% of the index, right? Today it is at about 13%, and it reflects the overall, composition of how not just the economy is doing, but how the various sectors are performing and various companies within those sectors are performing. To give you an idea, let's say, for example, FMCG was about 20%, right, of the index in 1995. IT was zero, FMCG was 20. Today, FMCG is only 8% of the index. So based on how the companies are performing, the index is a good reflection, right, on this. Of course, this is in the listed space. There could be activity in the unlisted space which doesn't get tracked by the indices.
Index investing is supposed to keep things simple, but with so many new indices being launched lately, has it actually become more complicated for investors?
Yeah, there has been a proliferation of indices.
Yeah.
Today there are about 400 of them, with equity itself having about 120. Right. So of course it has led to a very positive wave in passive investing, index investing. But at the same time, let's say if there is a fund which talks about waves, for example, right? Index. There is an index called Nifty waves or NSE waves. There is an index which is there for consumption and for new age consumption.
Okay.
Right now, how do I make out what is the difference? Forget about the ordinary investor. Even for qualified professionals who are tracking the market, it does become a bit difficult.
Yeah.
Beyond a point, right? So
Right.
somewhere this has to be kind of, maybe SEBI or the index makers or the mutual fund industry need to take a look at this and see how it can be ultimately beneficial for the ordinary investor.
Many big indices are dominated by just a handful of companies. So is that a red flag or simply how market cap indices work?
Yeah, that does. That's a very good point, actually. Right. One thing to remember is that, for example, the indices in India are based on free float market cap.
Mm-hmm.
Right. It's not necessarily the market cap itself. So when we calculate free float, for example, the government holding, the promoter holding is knocked out of the market cap, and then the residual which is available for free trading, right, is what is included in the index calculations. Right. To give you an idea, for example, we all know that Reliance is the largest market cap in India. It's about 1,85,000 crores. The next biggest is HDFC Bank, which is about 1,50,000 crores. Right. If you see market cap of HDFC Bank is as a percentage is about 7%. But when it comes to index calculations, because it's far more freely held, its weightage is almost 13%. Right. Similarly, Infosys, while its market cap is lower than TCS, on the index calculation, its weightage is higher than TCS, right, because of the free float. So what the index is capturing is essentially the free float based market cap. But having said which, yes, there are certain challenges that you rightly pointed out in terms of concentration, especially once we move into sectoral indices. Right. For example, Ruchira, if you take a look at banking, ICICI and HDFC dominate to the extent of almost 50% plus 53%. Right. So even if I'm buying a 20 stock index, I'm getting two stocks which are dominating it with 50%. In auto, Mahindra and Mahindra, right? Tata and Maruti, they again have a lion's share of 50% plus. So we do have to be mindful of what we are buying at the underlying level, right? When we are investing in these indices.
Right. Now, one last question talking about index funds. Say two funds, they track the same index. So why do their returns differ? Is it the expense ratio, tracking error, or something else that we're missing out?
Yeah, broadly, you have captured the points. Usually, yes, there is a tracking error, right? Because let's say if I'm a fund manager, right, I have to keep some cash for day-to-day, expenses, as well as for my redemption pressures, etc. Right? When mutual fund unit holders ask for a redemption, I need to have some cash. Usually, I keep 3%, 2%, 5% of, the overall portfolio value in cash or equivalent instruments. Right. And then second, I do have some expenses that get passed on to the investor in the form of expense ratios. Right. And beyond this, there is always, certain other parameters that come in. For example, how effectively am I redeploying, right, the dividend that comes out of these portfolio companies that I'm holding, right? Then also to a certain extent, depending on the index, etc., the fund size and the flows could also influence, how what is the tracking error of my fund versus another fund which is tracking the same index. But those marginal differences would be there from one fund to another fund.
Well, that was an insightful look under the hood of index investing. Thank you, Vishy, for breaking it down so clearly.
My pleasure. Thank you, Ruchira.
If you're enjoying the Index Investor series, don't forget to follow and share it with anyone building their long-term portfolio through passive investing. Thanks for tuning in. We'll see you in the next episode.